I think there are so many ETFs at this point. In the old days, when I started Delphi, there were 11,000 U.S. securities. Today, there are 3,600. And of course, most of them are in various baskets or indices, whether it's an overall index like the S&P 500 or industry index. And until we get washed out, I'm not convinced, because things seem to go up and down with high covariance. I mean, we've stuck with value for years, and we've done well on an aggregate basis, but we haven't been able to compete with the high flyers of, the FANG stocks in the last 2 or 3 years.
And so you mean the ETFs have impacted value investing in what way specifically? Just because they're a more attractive alternative to investors, or because they've sort of affected momentum more broadly?
No, because they load up on the good stocks as well as the bad, and there are fewer names today. It's harder to find the inefficiencies, and we own a lot of companies. For example, in the most recent quarter, 94% of our companies are recording record earnings. We have high returns on equity, 17%, which is about even with the S&P 500, with better earnings growth, and the stocks don't seem to go anywhere. And value definitely has been out of favor. The one time it got a burst was right after President Trump was elected. That was the first time that small mid-cap value had outperformed the larger indices. Otherwise, you have to go back to 2009 and 2010. But even Farmer French would tell you that value has systematically lagged since 2008, which is, contradicts the models that they have going back to, the post-war era.
But Scott, you're still combing through the market right now and looking for picks and specifically value picks. What do you like?
Okay, well, we'll give you a small one most people haven't heard of. It's called Hercules Capital. It's a BDC, but it focuses primarily in California on biotech firms and also on, technology itself. The stock sells at about a 1.19 times tangible book, 9 multiple, and gives you about a 10% yield. And the non-performing assets are like $2 million on $1.6 billion in assets. So it's very clean. They work with people like the Kleiner Perkins and the Sequoias of the world. It's not well followed. The market cap's about $1.2 billion.
Hey, Scott, Mike Santoli here. I wonder, a lot of the names you have to be encountering in your screens looking very cheap statistically are in sectors where they seem to be discounting, this cycle coming to an end, or at least the sector cycle potentially ending before too long. What's your call in terms of whether, in fact, the expansion can keep going to make some of these value stocks actually pay off for you?
Well, you have to be so careful now, Michael, because of the ramifications of trade barriers, things that involve with the supply side cycles, supply chain cycles like technology, auto-related. Those things you have to worry about because it's not clear what the legislation is going to be and what the ramifications are in the Trump administration. But the technology ultimately will grow. So I'll give you one that we sold at 118. It's back here in the low 90s. We bought it in the mid 80s. KLA. It's a terrific company. They have about less than $4 a share in cash on the balance sheet. The earnings will continue to go up because metrology is still a strong area, albeit it won't grow in double digits, maybe 9, 10%. But backing out the cash, it's selling at around 10 times expected earnings, which is a lot below the 17, 18 multiple of the market right now. And it's a very fine company, nothing but cash generation with superior technology and metrology.